FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Well, past 2 days, gold and silver have definitely been under attack. But what do you expect? It's Janet Yellen's first FOMC meeting. It's only to be expected. Here to talk about it, Jordan Roy-Byrne of thedailygold.com. Jordan, welcome back.
Hey, Kerry. Thanks for having me.
So you can't help but be a little bit frustrated, but it wasn't totally unexpected, was it?
Right. Well, especially given the setup we had last week, it looked like we had a breakout, and then that reversed quickly. And so there was some selling before the meeting, and obviously some selling after the meeting. Although it looks like today we hit a little bit of a bottom at 13.20 with gold. We're having a good bounce back. But yeah, it did seem kind of I don't want to say concocted or constructed, Kerry, because I'm not really one to talk about manipulation, but they removed the 6.5% target for unemployment. So in other words, employment can go below that, and they can still have this ridiculous, ultra easy monetary policy. And so looking at that over the long run, that's actually more favorable for precious metals. So looking at that, it's kind of surprising that the initial reaction was negative. So we'll see. Maybe this rally that we have right now is going to take us back higher.
Yeah, well, I'm not sure about the technical aspects of it, but it looks like we're having higher highs in the gold market and higher lows, which is generally a good sign, isn't it?
Yes, it is. I think the last time we talked was in December, and I was talking about how we're either going to get this final plunge or see this base where we just kind of start to rise slow and steady. And with respect to the stocks, I think the mining stocks were completely sold out in December. I definitely thought after that the mining stocks have bottomed, and I still hold that view. And it just seems like they're leading gold, and that's what you see at turning points. And gold's had a pretty good move from below 1,200 up to nearly 1,400. I would have liked to seen this go above 1,400 before we had this pullback, but it's in good shape, Kerry. Even if we have to do another couple months of bottoming, or even a bit more than that, the market is still in good shape, and the bear market is essentially over. So, we're in a good position long term. And, sentiment can remain muted until we get a strong break above 1420 or 1450.
Yeah, and it does look like we're headed for what you call a golden cross, where the 50-day moving average is going to cross the 200-day moving average, right?
Right, that's positive. I know there's a lot of people who are getting excited about that, and that is a good thing. And we'll see in the next week or two how that holds, if that goes through. And then if gold can remain above both of those moving averages, that would definitely be near-term positive.
Yeah, for sure. So that's the trend. It's heading there. The trend is your friend. I don't believe that the trend is just going to reverse itself in 1 minute. Generally, it doesn't work that way. And some of these beaten up juniors have really performed remarkably since the first of the year, haven't they?
Absolutely, yeah. The performance in some of those stocks, obviously there's so many of them, it depends what you're looking at, but I think GDXJ has gone up from something like 28 to 46, and that's a pretty good move. I think that's over a 60% or about a 60% move. And those are kind of that's the US ETF. So we're talking about the large established juniors, kind of the senior juniors, if you will. The ones that are smaller and the more true juniors, those have performed fantastically. I created my own basket, which I follow, and I think that basket is up about 80 or 90%. since the sector made a bottom in the middle of December. So yeah, I mean, the performance in those has been really, really good. And when you see stocks just moving that aggressively to the upside, particularly 2.5 years or even longer after a bear market, I mean, they're just not going back down to new lows. I mean, that's just not going to happen, not really possible. So yeah, the strength there is just another sign that the major trend has shifted back up to positive.
Yeah, so seeing a little bit of a pullback after that kind of increase wouldn't exactly be unusual, would it?
Yeah, absolutely. Absolutely.
I mean, we saw them like so beaten up. They were the most disfavored sector in the market, Jordan.
Absolutely, yeah. I mean, just the sentiment there was at 12, 13-year lows, just going back to December. And looking at the stocks in general, I'll throw out a couple statistics, which I think are very interesting. The price to book for the senior gold stocks in December, or I should say last year, it hit at least a 37-year low. There was a chart floating around that went back to 1980, and it showed that metric was lower than at any other point since 1980, and 1976 was a major bottom. So I'm just forecasting another 4 years onto that, which is very reasonable. So a 37-year low price to book, price to cash flow is at a 13-year low. And if you look at a chart of the gold stocks against gold, that hit I think about a 70-year low in favor of gold. Gold's been really outperforming the gold stocks, and that's not unusual, but it reached a major extreme. I mean, 70 years, that is really extreme. So looking at those statistics, and of course it filtered down, I mean, the underperformance and the struggling of the seniors, that filtered down to the juniors, who actually, they led the bear market down. I mean, it was the juniors who peaked in early 2011, and then silver stocks also peaked at the same time, whereas the senior gold stocks, actually, they got a final bump up there when gold went to 1900. So looking at the juniors and the silver stocks, they've been leading this recovery, and they kind of, the silver stocks peaked, I think, a couple of weeks ago, and I've seen some evidence that the juniors were starting a correction a couple days ago. So looking at all of those things, it says what you said, is that we've had a really good run and we're just having a correction here, and it's nothing to worry about. We're not going to retest the lows or anything like that.
Yeah, and the other thing here is you'll have to look at the fundamentals of the world economy, a little bit of liquidation after what's going on here in China, where their economy is literally imploding and they really don't know what to do about it here. And I say it's imploding because they've got this shadow banking system that they don't have a clue about. They really don't know what to do about it.
Right, and they've been building, of course, these cities that are really empty, and there's just so much, excess capacity there, of course, brought on by the shadow banking system. So I don't want to compare it to exactly what we had in our financial crisis, but they're definitely encountering some major problems over there, and that's definitely going to impact things. And you look at our economy, and nothing really great is happening. It's just kind of moving along with no real improvement. And I mean, looking at our economy, I'm just worried that inflation is going to start to really take hold. I mean, of course, if you look at these official statistics, it says that inflation hasn't taken hold, but I mean, we know that's a pile of garbage. But I mean, as far as the markets and the masses, they believe inflation hasn't taken hold, but I think it's definitely possible in the next year or two that we could really start to see inflation take hold. Because typically when you look at these long cycles, the inflation really comes about at the end of the cycle. And I'm talking about, you get your secular bear in stocks and secular bull in commodities that they average about 17 years. Well, we're, roughly 13 or 14 years into this. Maybe this one goes 18 or 19 years or 20 years, because the last one we had was only 13 years. And that, when you have a short bull market like that, the next one tends to be a lot longer. So given that, I mean, we're really in the time frame where inflation can really pick up. I mean, if you look at the 30s and 40s, inflation didn't really start to pick up until the end there in the early to mid 40s, and then it really picked up. Same thing with the 70s. I mean, we did have a burst there in the early 70s, but people thought things were under control even in 1976 when we had that major bottom. And the same can even be said, I know I'm going back really far here, but 1900 to 1920. I know that World War I has a big role in that, but inflation really picked up there in the 19 teens at the end of that cycle. So what I'm getting at is if you study history and what happens at the end of these cycles, that's really when you get your inflation. So we're looking at that. That leads me to believe that the time is ripe for people to really see inflation more noticeably, I guess you could say, coming in the coming years.
Yeah, no doubt you're right. And we're going to talk more about that up next on the Financial Survival Network.
FSN Radio.
Warning, you might live in a no constitution zone. It's the shocking story you won't see on TV. Depending upon where you live in the United States, you may no longer have constitutional rights. Politicians are quietly squeezing the middle class to micromanage you and extract your wealth. Want to see how? Watch the free video at noconstitutionzone.com. Soon, you'll have the last laugh by using these cultural contraband tricks and profit like a king. That's noconstitutionzone.com.
The Financial Survival Network. It's all about what's next.
We're back with Jordan Roy-Byrne of thedailygold.com. So, Jordan, we're seeing these things happen in China. To me, China is like the United States of 1929, really the heartthrob, the nerve center of the world's manufacturing. And we got overcapacity. You've got a population in China that is not going to become the consumption center of the world as long as they feel this uncertainty. They're going to put their money into savings, and they're not confident of their currency, so they're going to put it into gold and silver, which they're doing, right?
Yeah, I mean, I'm not an expert. I know there's lots of other analysts who follow the Chinese demand, but even given that the Chinese economy has really been slowing, I mean, the heavy demand there has stayed in place or even increased. So, I mean, that's a telling sign right there. I mean, the idea that, Chinese are not going to buy gold anymore because they're going to have this huge financial collapse. Well, I mean, at least to this point, it hasn't happened yet, and gold is still in high demand. And people in these emerging countries, they know currency depreciation and inflation much better than we do in the Western world because they've experienced it, they've seen it firsthand, and that's just their expectation that their currency is going to weaken over time. So what's going on there is, I guess, a catalyst for more buying of gold, and it's also got to be a catalyst for inflation. I mean, obviously, when you have the problems that they do, I mean, there's deflationary forces out there, but after deflation kind of strikes, there's always inflation that comes after and lasts longer. So, I mean, if China sees, I know that their currency has been weakening against ours, and I mean, if that's something that really continues and they have rising inflation there, that's going to lead them to buy more gold.
No doubt. And look, as the dollar's been losing purchasing power, the yuan, the renminbi, has been pegged to the dollar. So it's been going down with the dollar. So, the thought that they're going to back the yuan and make it convertible into gold, well, it's a nice thought, and maybe one day they will, but only when it has to be done, in my opinion. So these juniors, there's a lot of them that are still selling at liquidation value, basically for cash in the bank, correct?
Well, there are some. I mean, it depends what you're looking at, because as we talked about before, I mean, a lot of the stronger ones have already had a really, really good move off the bottom. So those are not selling for cash liquidation value anymore. I mean, some of those were to begin with, but there's still a whole lot of value there. I mean, you're seeing the companies emerge that really can do well with gold, with the gold price at 1250 or 1300. So, I mean, these stocks are having a rest, but whenever we see gold pick up again, and maybe it goes back to 1550 to fill that gap, whenever that happens, I mean, that's going to be another huge catalyst for these juniors. I mean, they can really have another big rise again. So I definitely think the value is still there, but you got to let this correction play out. You never want to buy anything that's just had a little vertical move or a rhino horn, as Jim Sinclair would say. You got to be disciplined and patient.
Mm-hmm. So you think the opportunity is still there, just because it's gone up, you haven't missed out or missed the last train out of the station?
Yeah, absolutely. And on that point, I mean, not to get too technical here, but looking at the stocks, you have GDX and GDXJ, I thought that they were going to have this pullback after they rallied up to their necklines. So in other words, I mean, these indices have clear resistance going back to last summer, and we got close to that, but we didn't reach it. Now, if you look at other groups of stocks, like if you look at the Explorers, GLDX, and you look at Silver Juniors, SILJ, those two segments have really been leading the sector. Those rallied up to their necklines. So all of these indices are in various different positions, but the necklines are really the key resistance going forward, probably for the next 6 or 9 months or so. And when we see the sector and these stocks make their next big move, I mean, that's going to be the key breakout coming out of this bottom. That's the breakout that when it happens, it's just final confirmation that we're in a new bull market, that the bear is long gone, and that everybody can see there's been a major turning point. So that's a technical level to really keep an eye on. With respect to gold, I would say that level is probably at 1420 to keep things simple. And until we break those necklines in the stocks, and until we break that in gold, I mean, there's still a really good opportunity you can buy and hold and wait for that breakout, because that's going to trigger the next big move. I mean, if you wait for that breakout to happen, you're going to be missing a good amount of upside. And if we're talking here next year, Kerry, I would guess that we've already had that breakout. We're trading a lot higher, and you've missed a big move. So I'm glad you asked that question, because that's kind of how we can kind of frame what's going on right now. Is we've had a decent move, but I don't see the next big move coming until the market gets in position to take out these necklines on the stocks, and also 1420 for gold.
So someone say with $10,000-$15,000, Jordan, what do you do?
Well, I'm not a registered investment advisor.
Hypothetically.
And not giving investment advice. Well, I mean,
if you listen to me, you're going to lose money. So don't listen to me.
Well, it depends on so many factors. I'm sorry to dance around the question, but
if it was you with 10, 15,000,
well,
what would you do?
I would buy select junior mining stocks, but if someone was on the opposite end of the risk spectrum, I would say you could maybe buy half gold, buy half silver.
Mm-hmm. Buy the metal and just lock it away or bury it in your backyard and forget about it, huh?
Right, but I wouldn't say you want to bury it, because at some point we know all bull markets end. I mean, because at some point, you want to, I mean, it's a whole nother conversation, but you don't want to hold these metals forever, because they're not going to, silver's not going to go to $200 and then stay there. At some point, the metals are going to be a sell. So that's why I don't know if you want to bury it in your backyard, but yeah, you just hold on to them for the next 4 or 5 years, and you should be fine.
Mm-hmm. So got you there. Makes total sense. And really, we're kind of in the middle of this precious metals bull market then, aren't we?
Right. Well, I would say we're kind of in the middle of this recovery. And like I said before, we're in the middle of this recovery. And so to kind of get out of the recovery phase, this initial rebound, The final move of that would be, breaking these necklines and gold breaking above 1420. But I would say, to use a baseball game analogy, I would say we're probably in somewhere in the 6th inning of this secular bull market. So I think we're past the halfway point, and roughly speaking, we probably have 5 years left.
5 years left. I think that's a reasonable number. So that will take us out roughly to 2019 to 2020, in that range, huh?
Right. Yeah. Maybe 4 years left. Not to hedge my answer, but 5 years is a good number, and what I think is going to happen, Kerry. I've looked at a lot of historical charts and kind of run them with the current market, and I think we're going to see a slow recovery, and that's kind of what we've been seeing. And the time it takes us to get back to 1900, maybe that's longer than the most ardent bulls expect. But I think once we see gold take out 2000, I think that's when you're going to see momentum really pick up. And I don't see that. I know some people are saying that's going to happen in a year, but I think that's too aggressive. I think we're going to see the market kind of continue this slow, steady recovery, and it's not going to pick up momentum until it gets closer to breaking out 1900. And so, that's the point when you could see the stronger momentum, and, we have all these inflationary problems, et cetera. But for now, we're still in that slow recovery phase, and it's just a great time to accumulate.
Yeah, so accumulation, hold the course, be patient, and be conservative too, right?
Absolutely. Absolutely. You should always, with buying, the stocks are obviously a lot more risky than holding the metals. But I always say with the stocks, something I've learned going through 2 cyclical bear markets is with the stocks, you have to have an exit strategy. These stocks they're not real businesses. They're not long-term holds. You can't really hold them for more than a couple years. For most of them, maybe there's a few that you can, like the royalty companies, but you need to have an exit strategy. If you buy something, I think 20% is a good number. If you put 5% of a portfolio and you have 20% downside in that investment, then your stop out point is a 1% loss of your total portfolio.
Well, that makes total sense. So we find you where, Jordan, and how do we subscribe?
You can go to thedailygold.com. You can sign up for my free newsletter. I have a box there on the top right. You just type your name in, you get a couple free reports. I have a premium service, and there's also a link to that on my website.
All right. And don't forget, go over to financialsurvivalnetwork.com. Look in the show notes to this interview. You get a link right to Jordan's site. And don't forget, sign up for our free newsletter. Got a great report going out tonight. All right, Jordan, thanks so much. We'll talk to you again real soon.
Okay. Thanks for having me, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.